And the question, and we're gonna talk to Trey in just a little bit, is whether you think that the retail investor community, many of whom are making a lot of money doing this at the moment, of course, that's if they sell, fully appreciate and understand all the dynamics at play here.
I don't know if I think that's a tough one, because I think what they appreciate is, and this has been the trend, you're seeing kind of this transformational trend among retail investors, among a whole new generation of retail investors. And what they appreciate is the incredibly high volatility, which leads to huge expected moves. So the reason that AMC is so, is in play right now, is so popular, is because with 300% volatility in the July options, the expected move over the course of the next month is a double. So either you're going to get the stock, it has an expected move plus or minus of $50. So if you have a $50 stock with a $50 expected move and you don't think it's going to zero, it's a pretty interesting kind of risk reward or pot odds play. And that's why I think there's so much interest.
So, there's a lot of people who look at this and they say this is not investing. We should not be encouraging this. This is speculation. This is a trading game. And there's big public policy sort of questions about what this all means. Where do you come down on all of that?
I'm actually a huge fan of what's happening right now and a huge believer in what's happening. I think this is really good. I think what you're seeing is an entire generation become engaged. So instead of waiting till they're 50 or 60 and trying to figure out what the markets are all about, they're doing it when they're 22 and 23. This is a generational move. AMC has nothing to do with it. Think of AMC as just another asset. Think of it like a digital asset, a crypto. Just think of it as the same thing. People are looking for speculation. Speculation is what turns them on. And I think the opportunity to participate in something speculative that you think you own, I think that's a really good thing. I think it's good for engagement. I think it's good for the markets. I think it's good for the future of finance.
Tom, I understand all of that, and I agree 100%. It's great to have younger people getting involved, whatever that may be, in investing on things.
Sure.
But what we've seen when this played out in the past, we had Joe Mowgli on yesterday talking about the day traders from the late 90s, the early 2000s. Those people, when they got burned, when momentum changed, when it was nothing but losses on the screen, a lot of them got driven out and away from the markets for decades after that. And that's really damaging. If you drive out a generation because the momentum turns against them, if they get burned badly and don't come back in, then you're talking about people who you're hurting that entire generation of ever being able to build wealth.
There's no comparison between the day traders, and I love Joe, but there's no comparison between the day traders of 1999 and 2000 and kind of that first kind of transition into online trading than what we're seeing today. It is a completely different world.
What's different?
I mean, well, the technology, the products, the markets, the cost. I mean, remember, back then, you basically got chopped alive with the width of the bid-ask differential and also the commissions and the fees. And then the quality of the technology was incredibly poor. Today, you're looking at amazing, we offer customers high-frequency technology. So your high-frequency technology, virtually no commissions, and a bid-ask spread that's a penny wide. It's the greatest marketplace in the world to learn how to take risk and how to kind of make probabilistic decisions.
Tom, how do you know that, I mean, in hindsight, it was it's obvious it was a housing bubble. How do you know that this isn't a big Fed-induced mania and that we look back on this as a once-in-a-generation phenomenon with a major policy mistake by central bankers, especially in this country, and it's all. None of this would be happening without it. That just pulls the rug out of the whole idea that it's a learning experience and good for long-term fundamentals and everything else. If it's all Fed-induced and it's a policy mistake.
And I agree with you, but what if it's not? What if it's just the maturation process of really liquid financial markets that are becoming stable. I mean, I'm not sitting here pounding the table as a bull or anything like that. In fact, I'm short the market right now. But when I look around and I see what's happening, it's different than 1999. It's different than 2008. The number of players today and the amount of capital today is massive compared to what we saw. Long-term capital management almost in 1998. Almost took us down, and it was a $2 billion, trade. Today we're talking about multi-trillion-dollar trades.
Tom, I got to stop you only because you just said you were short the market, and we only have about 30 seconds left. Make the case. You said you're short the overall market. You're short parts of the market. What's your view? And by the way, as you know, there's a lot of retail investors out there who believe that shorting the market unto itself is both immoral and shouldn't even be allowed.
Well, that's absolutely ridiculous. I mean, you know, that's beyond ridiculous. We don't have to even go there. But I'm a trader, and so I mean, you know, I run a couple of companies, but at the same time, I've always considered myself a trader. And as a trader, I like strategies where you're essentially short the market and short some premium. I like selling volatility. So for me personally, I prefer to be short the market and lean a little bit short and lean a little bit short volatility. It's just a strategy.
Shepard Smith here. Thanks for watching CNBC on YouTube.